What's the effect of high-frequency trading on ETFs? We're talking today with Doug Fabian about that very question. Doug, what do you think?
Well, I'm concerned about high-frequency trading. I see in some reports and circles that it amounts to 40% of the volume on the New York Stock Exchange on a daily basis. And you have computers buying and selling positions in a lot of them in exchange-traded funds, and they're doing it in seconds. And again, there's nothing illegal about what they're doing, but there's some circumstances that have happened in relationship to that. For instance, the May 2010 flash crash. I'm still yet to get a real good explanation as to what in the heck happened. How did the Dow fall 1,000 points in 15 minutes and then come back?
Right.
I mean, what went wrong? You know. Then we had, the Facebook IPO was a disaster. Then we had the night trading debacle where, some computer lost the company $400 million in 30 minutes. I know, I've heard stories about these high frequency trading money managers who have had 2 down days in the last 12 months. Well, that just seems like a rigged game to me. I'm having some problems with this.
Right.
I'm also seeing, and this is coming with some individual stocks, not so much ETFs, but I've been seeing some gap opens on some stocks. There's some income REITs that I follow, and 2 weeks ago, one of them opened down 13% in the first 10 minutes of trading. And then over the next 2 days, it was back to the price it was before that big crater.
Wow.
What was that?
Yeah.
I mean, how could somebody be so stupid as to sell so much to drive it down 13%? So I'm seeing these things, and now this relates back to how the markets work for me, because I've always been a proponent of using market order stop losses with your broker on your ETFs. And I'm hearing, and I've also seen, really bad execution, meaning investors have got a stop loss at 45 and they're getting filled at 44. So 2% lower than their stop loss. And without that much market volatility. That could happen on a very volatile market day, but just really poor order execution on the actual stop loss orders. And so now I've changed my philosophy, and you have to use different tools. I think there's too many people who have put their portfolios on autopilot and thinking that stop losses are going to save them from Armageddon, and it's actually creating friction, losses in their portfolio because of crazy things that happen during the course of a year. And now I don't recommend you use those anymore. So I believe that it does relate back to high frequency trading, and that it is not good for the marketplace. I think one of the reasons why people are giving up on equities in some circles, that they feel like it's a rigged game.
And we've got just a short time left here today, Doug, but what should people be doing?
Well, I believe now you need to, let's just take a look at your equity portfolio. You need to monitor and manage risk differently. And that means that you have to put more time in monitoring the portfolio. You have to manage risk a little bit differently, maybe taking some exposure off the table when the market's still in an uptrend. You've got to use some different tools. Again, we've always been a proponent of, kind of watching the 200-day moving average as a general barometer for the health of the market. So, if we do break the 200-day average, you would just lessen your stock exposure, but you can't put it on automatically.
Well, Doug, thank you so much. I appreciate the insight today.
You're welcome.
You're watching the MoneyShow.com video network.